Welcome, everyone. Today, we are going to explore how to use the trading volume indicator in RTrader Pro. This is a really powerful tool that helps you understand market activity and make better decisions in your trades. By the end of this session, you will know how to set it up, read it properly, and apply what you have learned to make better and more informed choices in RTrader Pro. Stick with me because I promise that by the time we are done, you will feel much more confident using this tool. Imagine you are trying to gauge the true strength of a market move. Is it genuine, backed by a crowd of participants, or just a fleeting blip? This is where the trading volume indicator becomes a game changer. To start, let us understand what the trading volume indicator actually does. It tells us how many shares or contracts were traded during a specific time frame. This helps us see how much participation there is in the market and how strong price moves really are. If the price of something is going up or down, volume tells you how much force is behind that move. Volume is often combined with chart patterns to give traders even better insights. For example, if you see a rising wedge pattern with increasing volume, that may indicate a strong continuation of the trend. Conversely, if the volume decreases during a rising wedge, it could be a sign of weakening momentum and a potential reversal. Understanding these patterns along with volume helps in predicting future price action more accurately. Let us dive deeper into some of the key chart patterns and how volume plays a role in confirming these patterns. The first pattern we will discuss is the head and shoulders. This pattern is typically a sign of a trend reversal. The formation consists of three peaks, a higher peak in the middle, the head, and two lower peaks on either side, the shoulders. Volume is crucial for confirming this pattern. During the formation of the left shoulder and head, you often see high buying volume, but as the right shoulder forms, the volume should decrease, showing a lack of interest in pushing prices higher. When the price finally breaks through the neckline, strong volume confirms the trend reversal. Another important pattern is the double top and double bottom. A double top forms when the price reaches a high level twice, but fails to break through, indicating strong resistance. The second top is often accompanied by lower volume, suggesting that buyers are losing strength. When the price drops below the support level between the two tops, high volume can confirm that a reversal is in play. The double bottom is similar but in reverse, forming two lows. The key to confirming the double bottom is a surge in volume as the price breaks above the resistance level formed between the two lows, indicating strong buying interest. Triangles are another common chart pattern, including ascending, descending, and symmetrical triangles. Let us break down each of these patterns in greater detail to understand their nuances and how volume can play a confirming role. For an ascending triangle, the price forms higher lows while repeatedly testing a consistent resistance level. This pattern is typically considered bullish, as it shows buyers are becoming increasingly aggressive, pushing the price higher each time it retraces. You want to see increasing volume as the price approaches the resistance level, and especially during the breakout above that level. This volume surge signals that buyers have gained enough momentum to push through the resistance, indicating a higher probability that the uptrend will continue. If the breakout occurs without sufficient volume, it could be a false breakout, and the price might fall back below resistance. Descending triangles, on the other hand, are bearish patterns. In this formation, lower highs are made while the price continues to test a consistent support level. This indicates that sellers are becoming more aggressive, pushing the price lower each time it rallies. Volume analysis here is crucial during the breakdown. Increasing volume as the price breaks below the support level suggests that sellers are firmly in control, and the downtrend is likely to continue. A breakdown on low volume could mean a lack of conviction, which may lead to a quick reversal or a failed breakout attempt. Symmetrical triangles can be a bit trickier because they can signal either a continuation or a reversal, depending on the direction of the breakout. In a symmetrical triangle, the price forms a series of lower highs and higher lows, essentially converging towards a point. This represents a period of market indecision, where neither buyers nor sellers have a clear advantage. The volume typically decreases as the pattern progresses, reflecting this indecision. What you want to watch for is a sharp increase in volume during the breakout, regardless of the direction. A breakout to the upside with increasing volume confirms that buyers have taken control, while a breakdown with high volume indicates that sellers have won the battle. Without a volume spike, the breakout may lack the strength needed to sustain the move, making it less reliable. When trading triangles, it is also helpful to consider where they occur within the broader market trend. Ascending triangles in an uptrend are generally seen as continuation patterns, reinforcing the bullish sentiment. Conversely, descending triangles in a downtrend serve as continuation patterns for further decline. Symmetrical triangles are more neutral and can occur in either trending or consolidating markets, making volume analysis even more crucial to determine the likely direction of the breakout. In all cases, paying attention to volume is what makes the difference between a confident trading decision and a potential trap. Volume is the confirmation that adds credibility to the price action you see, helping you gauge whether the breakout or breakdown is likely to be sustained or if it is simply a head fake. The more thoroughly you understand these patterns and the role volume plays, the better you will be at anticipating the market's next move and positioning yourself accordingly. The rising and falling wedge patterns are also very important. A rising wedge, where price is moving upward within a narrowing range, often signals a bearish reversal. If volume is decreasing as the wedge forms, it means that fewer buyers are stepping in to support higher prices. When the price eventually breaks down out of the wedge, a strong increase in volume confirms the bearish signal. The falling wedge, on the other hand, is a bullish pattern where decreasing volume during the formation of the wedge, followed by a surge in volume during the breakout, confirms a potential reversal to the upside. Flags and pennants are continuation patterns that usually follow a sharp price movement known as the flagpole. The flag itself is a small rectangular shaped consolidation that moves counter to the trend, while the pennant is a small symmetrical triangle that indicates a period of consolidation. For these patterns, volume is typically high during the formation of the flagpole, which signifies strong momentum and trader enthusiasm. During the consolidation phase, volume generally decreases, reflecting a pause in the trend as traders take a breather or reassess. This drop in volume during consolidation is expected and healthy, as it suggests that traders are not aggressively betting against the prevailing trend. In the breakout phase, volume should increase again to confirm that the original trend is resuming. Ideally, the breakout should occur with a significant surge in volume, as this signals that the market has renewed interest and strong buying or selling pressure is supporting the continuation of the trend. If the breakout occurs on low volume, it could mean that the move lacks conviction and might fail. Therefore, watching volume closely helps determine whether the pattern is likely to succeed or if it might result in a false breakout that could trap traders. Flags are often seen as slightly sloping rectangles that move against the prevailing trend, either down in a bullish market or up in a bearish market. A flag's tight consolidation represents a minor pullback before the original trend resumes. Pennants are similar, but instead of moving as a rectangular channel, they form a small triangular consolidation. This triangular shape occurs because the trading range narrows as traders wait for a clearer signal. When analyzing these patterns, it is also important to consider the time frame. Flags and pennants can form in different time frames, from intraday charts to weekly charts. The key is to match the volume behavior with the breakout action. A strong move in a smaller time frame needs a volume surge to prove itself, whereas a longer-term flag or pennant can rely more on broader market trends with supporting volume over several days or weeks. Additionally, it is common to see false breakouts in flags and pennants, especially if volume is not aligned properly. A false breakout occurs when the price briefly moves beyond the flag or pennant's boundary without significant volume support, only to reverse back into the pattern. This often catches inexperienced traders off guard. To avoid being caught in such moves, it is critical to wait for the volume to confirm the breakout. The more volume behind the move, the more reliable the signal. Recognizing the role of volume helps traders not only enter trades at the right time, but also manage their risk effectively. Understanding flags and pennants and how they interact with volume is essential for traders who wish to make informed decisions in continuation trends. By mastering these concepts, you can enhance your ability to determine whether a market move is likely to persist, allowing you to time your trades with greater accuracy and reduce the likelihood of falling for false signals. Broadening formations, sometimes called megaphone patterns, involve price swings that become increasingly wider. These are typically seen in highly volatile markets. Volume analysis in broadening formations is a bit tricky. Typically, volume increases as the swings become more exaggerated. The breakout direction is often confirmed by a significant increase in volume, signaling that the market has chosen a direction after a period of indecision. Understanding these chart patterns and how they relate to volume gives traders a better chance of anticipating price movements. Combining volume with these patterns allows for a more complete picture and helps filter out false signals. When you are able to recognize these patterns and confirm them with volume, your confidence in making a trade grows significantly, whether it is entering, exiting, or adjusting your position. This is really important when deciding if you should buy, sell, or just sit tight. Now, let us jump into how to set up the volume indicator in RTrader Pro. First, you need to open the indicator menu. You will find the volume indicator in the Technical Indicators section. After that, choose the time frame that best suits your trading style. If you are a day trader, you might want to use 1-minute or 5-minute charts. However, if you prefer a broader view, like a swing trader, you could choose hourly or even daily charts. Take a moment to set your display settings as well. Make sure that the volume bars show green for buying volume and red for selling volume. This will make it much easier for you to see what is happening at a glance. Now that you have it set up, let us talk about how to read the volume indicator. Imagine you see prices rising along with increasing volume. This tells you there is a lot of buying happening, which is a sign of a healthy uptrend. But if you see prices rising while the volume is falling, that is a warning sign. It means that fewer people are buying and the uptrend might be losing steam. This could mean a reversal is coming soon or that the market might start moving sideways. On the other hand, if prices are falling and you see volume increasing, that tells you sellers are in control. It is a sign that the downtrend might continue. This is especially important if you are trying to decide whether to enter or exit a trade. Do not forget that volume spikes are also important. A volume spike is when you suddenly see a big jump in trading activity. These spikes often happen at key price levels, like when prices reach support or resistance points. If you see a volume spike while the price is breaking through a key level, that is usually a sign that the move is real. But if the price stalls after a volume spike, it could mean the market is not sure what to do next, and a reversal might happen. Let us keep going by talking about how to use volume to confirm breakouts and reversals. This is where things start to get really interesting. If the price breaks through an important resistance or support level and volume is high, this means the breakout is likely real and might continue. This could be a great moment to enter a trade with more confidence. But if you see a breakout happening with very little volume, be careful. It could be a false breakout, and in that case, it is often better to wait until you get more confirmation before entering a trade. For reversals, watch for increasing volume as well. If you see the price reversing at a key level and the volume is picking up, that is a pretty good sign the reversal is for real. There are also some specific trading strategies you can use with the volume indicator. Let us discuss these in greater detail, starting with volume confirmed trend trading. If prices are rising and you see increasing volume, that is your confirmation that the trend is strong. This could be a good time to stay in a trade longer or even add more to your position, as it signals that the current upward momentum is being supported by market participation. Similarly, if the price is declining and you see increasing volume, it confirms that the downtrend is well supported, providing an opportunity to either maintain a short position or even add to it. For breakout trading, volume plays an absolutely critical role. You always want to see a surge in volume to confirm the breakout. This surge in volume indicates that there is strong support for the price moving beyond a key level of resistance or support, which increases the probability that the breakout will hold. Once you have that volume confirmation, you can confidently enter the trade in the direction of the breakout. Just make sure the volume is there to back it up. If you do not see increased volume, the breakout might be weak or even false, which means the price could quickly reverse and move back into its previous range. And for reversal strategies, volume spikes are crucial at important levels. If the price hits a resistance level with high volume and then starts to reverse, this can be a very strong signal that a trend change is occurring. In this situation, you might consider entering a short trade, especially if other indicators also support the reversal. The key here is that the volume spike adds reliability to the reversal signal by showing that a significant number of traders are involved and momentum is shifting. Let us also discuss volume exhaustion patterns. Volume exhaustion occurs when a price move reaches an extreme level and volume spikes dramatically, but then quickly falls off. This often indicates that the market has reached a point of exhaustion and a reversal is imminent. For example, if an asset has been in a strong uptrend and suddenly sees a massive spike in volume without significant price movement or with a small price increase, it may indicate that buyers are exhausted and a reversal could follow soon. This is a valuable pattern to watch for, especially when trying to anticipate the end of a trend. Another interesting approach is volume divergence. Volume divergence occurs when price movement and volume are not aligned. For instance, if the price is reaching new highs but the volume is decreasing, it can signal that the strength behind the price movement is weakening and a reversal may be on the horizon. Conversely, if the price is declining but volume starts increasing, it could mean that selling pressure is intensifying, which might lead to further declines. Using these volume-based strategies along with proper chart analysis allows traders to make well-informed decisions and manage their trades with greater confidence. Whether you are trading trends, breakouts, or reversals, always remember that volume serves as the pulse of the market, helping you assess the strength behind price movements. While the basic volume indicator is already very useful, you can also use other tools to help you make even better decisions. For example, on-balance volume, also called OBV, keeps track of whether volume is flowing into or out of a stock. When OBV is moving up along with the price, it means the uptrend is strong. The volume oscillator is another helpful tool. It compares short-term and long-term volume to show changes in momentum. This is useful if you want to see if a move is gaining or losing strength. Another tool is the accumulation and distribution line. It combines both price and volume to show whether people are buying or selling. This can be a great way to confirm if price movements are real and if they have real buying or selling pressure behind them. Now let us talk about some common mistakes that people make with the volume indicator. The first mistake is overtrading based on small volume spikes. Not every volume spike means a big move is about to happen. It is important to look for other signs like price action or other indicators before making a trade based on volume alone. Another mistake is ignoring volume when you are analyzing a trend. A price move without volume support might not be reliable and could reverse quickly. Remember that volume is a very helpful tool, but you should always use it together with other indicators to avoid false signals. Speaking of combining volume with other indicators, let us talk about some of those combinations in greater detail. One of the best ways to use volume is with moving averages, which can provide a strong signal when used together. For example, if the price is above a moving average and the volume is increasing, that tells you the trend is likely to continue, indicating strong market sentiment. However, if price moves above a moving average with declining volume, it may signal that the move lacks strength and could be a false continuation. Moving averages paired with volume can also help identify pullbacks and possible re-entry points, as increasing volume on a pullback might signal that the price is set to continue in the direction of the larger trend. Another powerful tool to use with volume is the Relative Strength Index, or RSI, which helps spot overbought or oversold conditions. If you see that RSI is showing overbought and volume is starting to drop, it could mean a reversal is near. This is especially true when volume peaks align with RSI extremes, as it often signals that the current trend is exhausted. On the flip side, when RSI indicates an oversold condition and volume starts to rise, it could indicate that buyers are stepping back in, potentially signaling the beginning of a new uptrend. This combination helps you anticipate shifts in market direction more accurately. The Moving Average Convergence Divergence, or MACD, is another excellent tool to combine with volume analysis. MACD is very effective at spotting shifts in market momentum, and adding volume analysis helps you gauge whether the momentum is strong enough to sustain the price movement. For instance, when the MACD line crosses above the signal line, it may be a bullish signal. If this cross is accompanied by rising volume, it indicates strong momentum and greater reliability of the bullish signal. Conversely, if the MACD crosses without much volume support, it could mean the move lacks conviction and might fail. Volume also helps confirm MACD divergences. When price moves in one direction but the MACD moves in the opposite, the divergence may indicate an upcoming reversal. If this divergence is accompanied by significant changes in volume, it makes the signal even stronger. Another useful combination is pairing volume with Bollinger Bands. Bollinger Bands help identify volatility and potential price breakouts. When price approaches the upper or lower band with increasing volume, it often confirms a continuation or breakout in that direction. Conversely, if volume is low when price hits these bands, it may indicate a lack of strength and a potential reversal or consolidation. When volume expands sharply along with price breaking out of the bands, it is a strong indicator that volatility is increasing and the breakout is likely to continue. Volume can also be combined effectively with the stochastic oscillator, which measures the current price relative to the price range over a certain period. When stochastic readings are in the overbought or oversold territory and volume spikes, it often suggests a turning point is near. If volume supports a change in the oscillator direction, traders can have greater confidence in an impending reversal. For example, if the stochastic oscillator signals overbought conditions and you simultaneously observe a decline in volume, it could indicate waning interest and the possibility of a bearish reversal. Finally, volume also works well with support and resistance levels. Support and resistance are critical points where price may reverse or consolidate. When price approaches these levels with rising volume, it increases the likelihood that the level will break. Conversely, if price reaches a key support or resistance level with declining volume, it suggests that the move lacks the strength necessary to break through. Watching volume around these key levels helps you anticipate whether a breakout or reversal is likely, allowing you to position yourself accordingly. By combining volume with these various indicators, you get a clearer and more nuanced view of what is happening in the market. Volume adds an extra layer of confirmation that helps you determine whether trends, reversals, and breakouts have the backing of strong market interest, making your trading decisions more informed and reducing the chances of false signals. Volume can also help you manage your risk better. For example, you can use volume to decide where to place your stop-loss orders. Try putting your stop-loss just beyond key volume levels. If the price breaks through those levels with a lot of volume, that might mean a big move is coming and you need to be ready. Also, think about your position size. You can take larger positions when volume supports your trade because that means the move is more likely to be real. When volume is low, take smaller positions since low volume moves can be unpredictable and might reverse quickly. Before we wrap up, let us recap what we have covered today. The volume indicator in RTrader Pro helps you confirm trends, breakouts, and reversals by showing how much activity is behind price moves. We talked about volume spikes, rising and falling volume, and using other tools like on-balance volume and the volume oscillator to make better decisions. We also discussed combining volume with moving averages, RSI, and MACD to get stronger signals. And finally, we talked about risk management and how volume can help you place better stop-loss orders and decide how big your position should be. Volume is a crucial part of successful trading. The more you practice using the volume indicator in RTrader Pro, the better you will get at spotting high-probability trades. Keep an eye on how volume lines up with price action and use it together with other tools. The more you refine your strategy, the better results you will see in your trading performance. Stay engaged, ask questions, and keep learning. The more you understand how volume works, the more confident you will be in your trades.